Have you ever been in the position where you found what seems to be the perfect trade setup, so you decide to jump into a trade, and at first it seems to be going okay, but then all of a sudden, the market just completely crashes on you, and you're just left wondering what went wrong? Well, in the majority of cases, the likely issue is that you missed something important on a higher time frame, and this is the most common error that traders make when day trading. They only use one or two time frames for their analysis, which leads them into misunderstanding the context of the larger market structure, which is what actually dictates which moves the market intends to make. So to correct these mistakes, in this video we are going to cover what we call top-down analysis, which will show you how to actually read a chart's market structure on a multi-time frame basis, which will make sure you don't miss any of the important details that you might have previously overlooked, as well as give you the strategies to find the best entries for your trades. So let's waste no time and start with step number 1, which covers what top-down analysis actually is and how we use it in our trading strategies. Within top-down analysis, the idea is that you should actually be using all of these time frames when looking for potential trade setups. And the way this works is by starting your chart analysis on the monthly time frame and then work your way down until you reach the time frame that you want to actually use for your entry setups. But to understand why, we will split these time frames into 3 different categories, with each of them being used for a different purpose. The first category are the higher time frames, which consists of the monthly and weekly time frames. The role of this category is to give us the context of the market, which involves identifying the trends of the larger scale price action. The second category are the medium time frames, which consists of the daily and 4-hour time frames. We use this category to look for potential trade setups that align with the larger market structure. And then for the third category, we have the lower time frames, which consists of the 1-hour and 15-minute time frames. And this category is used to actually enter our trades, using the market analysis from the larger time frames. But it's rare that you'll actually see a trader use all 6 of these time frames. And this is because the time frames that a trader will use will depend on their personal preference and trading strategies. For example, a position trader might prefer to use the monthly, daily, and 1-hour time frames to target the larger market moves that play out over a long period of time, whereas the time frames that you typically see a day trader use would be much lower because they are more focused on taking trades that might span only a few hours. But the point is, it doesn't matter what type of trader you are, top-down analysis will always be an important part of successfully reading a chart. So let's now move on to the next step, where we will show you how we actually use top-down analysis on a chart and to give an example of the specific criteria we are looking for from each time frame category. So here we have a chart, and for this example, we are going to use the pathway where we start on the weekly chart, before then using the 4-hour time frame, and finally the 15-minute time frame. But in the case that you don't personally use the time frames we are using within this example, it doesn't matter. And this is because time frames are fractal, which means no matter what time frames you choose, the process of top-down analysis is still the same. And as a side note, we are going to use 3 time frames in these examples, but you can use as many as you think will help you find your edge, but it should always be at least 3. So now going back to this example, let's start our analysis on the weekly chart, which as we mentioned in the last step, is in the higher time frame category, which means what we are looking for is the general directional bias of the market structure. And this is important because the decision of whether we should be looking for long or short trades on the lower time frames will be dependent on the directional bias we can establish on this weekly time frame. So to find out which direction we should be looking to trade, there are 3 steps we need to go through. The first step involves breaking down the current market structure to find the current order flow of the price action. The second step involves identifying the key levels that the market might look to target. And then the third step involves figuring out which key level is the current draw on liquidity by using the context of the PD arrays within the chart structure. So let's go through this process now. Starting with the first step, the method for how we can find the current order flow of the price action is very simple. All we need to do is go through the previous moves of the chart and mark every break of structure and change of character that formed, because this will tell us which direction the market is currently trending. And for this example, we can see that the market is currently bullish, with the most recent move creating a bullish break of structure, which suggests we should be looking for long entries to align with the current uptrend. But this only tells us what the market did previously and not what it intends to do next. So let's now move on to the second step, which involves identifying potential targets. And when we talk about targets, we are referring to any PD arrays on the chart that the market might target to create its next move. And these can be previous swing highs and lows, the wicks of the previous candle, fair value gaps, order blocks, mitigation blocks, or breaker blocks. So with this in mind, we now need to analyze this market structure and look for any PD arrays that we can find. So as a start, we can mark out the previous swing high and swing low levels, as these are the current external range liquidity levels, of which one of them will be the main target for the price action. And if, for example, the upper liquidity level is the level that ends up being broken through, this would create a new bullish break of structure, continuing the uptrend. But on the other hand, if the lower liquidity level was the level that ends up being broken